G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Wargent Property Buyers, and I'm delighted this week to have a recurring guest, Cameron Kusher, one of Australia's leading housing market analysts for so many years now. Cam, I've lost count, and formerly of the REA Group, and then before that, CoreLogic Australia, and I can't even remember what came before that. You've been around the traps for so long. Cam, it's great to have you back on the show.
Thanks for having me, Pete.
I always say this when we have you on, that of all the years I've been doing podcasting, all of my top episodes are the ones that you're on. So obviously people value your insights more highly than they do mine, but that's good if it gets the numbers up. So tell us what you've been up to a bit of late, Cam. So I know you've had a change of roles pending, and you might be making a bit of a change of direction.
Yeah, so in February, I left REA Group. I'd been there for 5.5 years, and basically now I'm just looking for the next opportunity. So in the meantime, I have been setting up my own Substack just to share my thoughts. I'm still pretty active on LinkedIn and Twitter, but if you are interested, my Substack is cameronkusher.substack.com, and that's very much the content I'm posting there is very much focused on the economy, the housing market, and what those insights about the economy and housing market mean specifically for the property market. It's all free, so you don't have to pay for that Substack, but I would love you to join and, comment, let me know what you think about things. But outside of that, yes, at the moment, just on the lookout for the next job opportunity.
I am a follower on your Substack, so we'll put a link actually in the notes so you can sign up there and get the free email updates and blog updates. And I'm sure you don't need my endorsement, Cameron, but you've been one of the top market analysts in Australia for well over a decade now. I can't even remember how many years, but I guess you're a very familiar face across all of the TV, radio, print media. And if anyone's on the lookout for a market analyst to grow the profile of their business, then I'm sure you'll be hot property over the next few weeks. So get in there quick, because there's very, very few people with your level of insights and experience in the industry. So you'll be a hot acquisition for whatever comes next. So good luck with the search.
Oh, thank you very much.
So what should we talk about today? So there's so much going on, and I'm pretty conscious that the way things are changing so rapidly, by the time this goes to air, we'll probably all would have changed again. But the time of recording anyway, we've had all of the Trump tariffs going on, and then I suppose at the time of speaking anyway, Trump has put a bit of a pause on some of the excess tariffs on other countries around the world, but it looks like those enormous tariffs on China are going to stick. Of course, Australia over the past 20, 25 years has increasingly been seen as a bit of a proxy for the Chinese economy. If they're growing, then we tend to grow off the back of it. And so obviously there's going to be some implications here if there's a massive trade war between the US and China. What kind of conversations have you been having recently? And have you thought through some of the potential scenarios? But while bearing in mind, of course, things are changing very rapidly at the moment.
Yeah, I mean, obviously, to me, it seems crazy what's going on. At least a 10% tariff on every single country in the world. Even larger tariffs on islands that just have penguins on them. But Trump certainly doesn't seem to be backing down from the tariffs on China, and China is our largest trading partner. And I think that the concern there is if we do see a slowdown in China on the back of these tariffs, that there's going to be a lot less demand for our iron ore and coal. And then that is going to hit the Australian economy. But the pause on tariffs and the relatively low tariffs on Australia are fairly encouraging. What's been interesting over the last week, though, is the movement in the cash rate futures yield curve. And as of yesterday, they had a cash rate of 2.73% by the end of this year. So that's obviously quite a lot of interest rate cuts we're looking at. Now, given that the implementation of the tariffs have been delayed for 90 days, I do wonder if that's going to change a little bit today, although I did notice that NAB put out today that they expect quite a few cuts. I think it's about 125 basis points worth of cuts from where we are today this year. And that's going to be positive for the housing market in terms of that's going to lower borrowing costs. It's going to increase borrowing capacity. I do, though, think that possibly the government and regulators will be worried by the fact that we have come off such a strong period of price growth over recent years, and we're now going to be seeing potentially an aggressive lowering of interest rates, and that could just push property prices even higher. But, with the uncertainty that we've seen in the share market over the last few days, I think that the housing market will become more attractive for a lot of people looking for somewhere to park their money. Yes, it's not as liquid as the share market, but that's actually a good thing, because volatility like this and announcements from, one crazy person in charge in the US doesn't lead to a wild fluctuation in the housing market like we can see in equities and bonds.
It's been a pretty interesting shift in the backdrop, hasn't it? I think if you went back to the Clinton administration, when the US was running budget surpluses, and then there was a lot of talk back at the time of the merits of a balanced budget. But since the global financial crisis, and I guess the bailouts have followed, Lehman Brothers collapse, and then all of those bouts of quantitative easing as well, of course. But those deficits over $1 trillion, and in more recent years we've seen $2 and $3 trillion deficits in the US, and we've almost got accustomed to that being the case, to the extent that the US now has a national debt of an astonishing $36 trillion, and it seems like Trump is hell-bent on bringing that budget back towards balance. And I suppose ultimately there's only two ways you can do that. One is cut spending, and we've seen how popular that's been with all of the protests around in Boston and everywhere else around the US. But the other way is to raise income, and tariffs, particularly on China, seems to be one of the first ports of call. And that's going to have enormous implications for, as you said, global trade. We've seen a lot of turmoil in financial markets, and some countries have seen their long bond yields actually shooting up in recent days. But as you say, in Australia, we're slightly sitting outside what's going on in some of the other parts of the world, because, I guess as a proxy for Chinese growth, we've seen a massive shift in interest rates. But as you mentioned, it's not like in Australia where people, in the US, where people might have a 30-year fixed rate mortgage. In Australia, people generally have variable rate mortgages, or the very most we maybe get like sort of 3 or 4 year fixed rate mortgages. So people are much more attuned to what's happening at the short end. 3-year bond yield is now about 3.3%. As you said, the cash rate futures have just dropped off a cliff, and markets are pricing in 4 or 5 interest rate cuts over the next year or 15 months. So as you said, I mean, that historically, and I know you've done plenty of analysis on this, but I suppose generally speaking, an interest rate cut adds to borrowing capacity, adds to demand. One of the things I wanted to ask you, we've still got in place in Australia a lending assessment buffer of 3 percentage points, which obviously restricts a lot of lower income earners from borrowing at all, because they're being stress tested for 9 or 10% mortgage rates that they're never going to pay. I know you've got your ear to the ground on this kind of stuff. Is there any sense that might actually change, or is APRA just going to hold the course right the way through this cycle? What do you reckon?
Yeah, look, I think they're probably going to hold the course. There's been nothing really from the Council of Financial Regulators or the RBA or ASIC or APRA that are part of that suggests that they're going to ease off on those buffers. And as you say, there's a lot of people out there that, realistically could, are creditworthy. The banks would happily lend to them, but they simply can't at the moment. And the people it does impact on the most are lower income households, first home buyers trying to enter into the market. Although, as I saw you posted the other day, there's now they're not assessing HEX debt as part of borrowing, so that will increase borrowing capacity for people probably trying to get into the market for the first time. I think it's an interesting discussion, though. Now, look, I don't think that APRA would ever do this, but I guess if you are worried about lower interest rates, and especially very aggressively lower interest rates leading to higher property prices, you could actually tighten lending policy as interest rates come down and increase that buffer. Now, I'm not saying that's a good thing. I'm not saying they should do that. But I do wonder if it's something that they're maybe considering, given that we have seen such a large increase in prices over the last few years, and given that we know that historically a big reduction in interest rates would lead to higher property prices.
Oh, it's definitely a possibility. I suppose the counter argument would be mucking around with the monetary policy transmission mechanism, and if you're not allowing people to borrow, then some of the impact of interest rate cuts is immediately stymied. But also, you're blocking the supply response function as well. I think I've been thinking for a long time that we will actually need to see, particularly in a city like Melbourne or Sydney, if established apartment prices are moving, nobody's building because there's just no profit in there for developers. And if you're going to sort of try and constrain price movement, then you might block the supply response as well. And I mean, I guess just progressively over the past 15 years, lending standards have just got tighter and tighter. And I know a lot of people who are small-time property developers, they just can't access finance full stop at the moment, even though they would love to do developments. They're blocked out. I think the other thing is I guess if you set a 3 percentage points lending assessment buffer, well, it's all well and good if you've grown up in Vaucluse and your parents are shoehorning you into the housing market, but you're just going to get a mismatch, and people with household incomes of under 200,000 are just going to be by and large shut out of the market. So you'll end up with a sort of a gulf between, or a disparity between the haves and the have-nots. But
I think there's a couple of points that are really pertinent. So firstly, the data from CBA shows that most of the mortgage lending is flowing to people that are on incomes of around more than 150,000.
Yeah, right.
And when you look at how many people actually earn more than 150,000, it's a lot less than half. So we've certainly crimped credit quite significantly, and you do have this situation of the haves and the have-nots. And in terms of the housing supply and developers, I mean, you go and talk to a lot of developers, they say we need established prices 20% higher just to make these new projects viable. And I think a lot of people are going, well, can't they just cut their price or reduce their margins? They can, but then there's actually no benefit for them to take on that risk to develop. So you simply won't get new housing construction happening. And as it is at the moment, most developers aren't able to go to your normal banks. They're having to go to private credit where they're paying higher interest rates. So it's a real challenge, and we definitely need to be sensitive to what we're doing and how we can get more housing supply, because lower interest rates will help. But there's still this, as you said, in Sydney and Melbourne, a massive mismatch between established prices and new prices. And that's seeing a lot of people just preference buying something that's already existing rather than something brand new. And if you don't get people buying brand new, you don't get new housing built.
Yeah, so one of the questions I actually had was on the housing accord target of 1.2 million homes over 5 years. And I think, to be fair to the government, there's definitely a cyclical element to this. But it seems, if you look at a lot of the measures like building approvals, building or dwelling completions, we're running at maybe 15, 16,000 a month, and maybe picking up a little bit in some parts of the country. Melbourne seems to be doing better than some other cities. Maybe zoning's a bit friendlier down there, potentially to some extent. But obviously, to get 1.2 million homes in 5 years, we would need to see, I guess, 20,000 a month would be the kind of run rate we'd be looking to see. And we've been tracking below that all the way through. Are you seeing any prospect of that picking up as interest rates come down? To your point on developers, I know a lot of people, you probably speak to the people at the bigger end of town. A lot of my clients are small-time developers, but a lot of people have had to go outside of the banking system to the non-banks, and they're paying 8 or 8.5% mortgage rates to get developments done. And there's just no profit. The cost of construction has absolutely rocketed over the past 5 years. And why take on a development for a 10 or 15% margin when there's so much risk around what's happening elsewhere? So anyway, how are you seeing the housing accord target play out? Are we any prospect of things picking up as the year goes on?
Well, I think if we see that interest rate cut profile that is now being expected, we'll certainly see a pickup in approvals. A lot more projects will become viable. Again, though, I think the thing to remember with building approvals, you usually don't seek a building approval till you've got your finance in place and are basically ready to start construction. And in order to do that, you need to get the level of pre-sales you need to trigger that approval. So I think things will start to pick up, but we're still hopelessly short of where we need to be for the number of building approvals. Not every building approval goes ahead. A lot of projects get scrapped or unfortunately, at the moment, a lot of builders and developers are going bust as well. So you actually need to be approving a lot more than 20,000 each month in order to hit that housing accord target, and we're not there. If we look over sort of the first 8 months of this financial year that we've got data for, we're about 60,000 approvals behind where we need to be for completions. So I think things will improve with that lower interest rate environment, but I think there's very little chance that we get even close to the 1.2 million new dwellings that the federal government's aiming for.
I think sometimes these kind of conversations, they feel a bit esoteric when you're throwing numbers in there to people. But I was just at the HIA event in Brisbane 2 weeks ago, right in the heart of Brisbane. And directly across, obviously a lot of the conversation, the HIA, is about housing supply, difficulties facing builders with skilled labour shortages, but also cost of materials, interest rates being too high to make projects work. And directly across from the venue, there's a park there with 20 tents in it. I've never seen anything like that in Australia. And it's not just Brisbane. It's if you go up to Caboolture, enormous tent cities, go to Gympie, it's all over southeast Queensland. I can't really speak for other parts of the country, but this is a very pressing issue, and the government is trying to do its part. But there's just the dynamics of supply and demand at the moment are mismatched. Did see a report from Urbis a week or two ago, which sort of underscores the challenges with construction costs and apartment prices. And their stats seem to show that for new apartments, prices are up about 33% over the year, and they're up even more in Brisbane, which looks like about a doubling since 2019 to about $19,000 a square meter. I mean, I don't know for sure, but that suggests to me that the new housing supply is being driven much more so by owner-occupier buyers in Australia. I think in the previous cycle, it was more driven by foreign investors getting a lot of the pre-sales up, investors from mainland China, but they've largely been locked out of the market now with stamp duty surcharges. But I know you're closer to what's going on with developers. Is that the general shift? The developers are having to build much more product for people to live in and far less investor-style stock now?
Yeah, 100%. I mean, you go and talk to developers and, you say there's obviously demand for 1 and 2 bedroom apartments out there. Just go on the internet and have a look at how many people want to buy an inner city apartment, apparently. But they can't make it for a profit. I mean, as you said, the rate per square meter nationally for a new apartment is 19,000 a square meter. Now, that's probably somewhat overstated by the fact that most of the product is the owner-occupier segment, but that's the only thing that's stacking up. Where you do find some of that smaller product stacking up, you're talking about $12,000, $13,000 a square meter. Now, if you're looking at a 50 square meter apartment, that's $600,000 for a 50 square meter 1 bedroom apartment. People just can't afford that. And again, you go to the secondhand market, that property will probably cost you $400,000, maybe $420,000 to buy. So it's very hard to make that product stack. Now, the problem with this, as you said, when we were getting a lot of new housing, apartments in particular, a lot of it was being bought by investors. So what that meant is when you had an apartment project, there were a lot more 1 and 2 bedroom product. Now it's largely 2, 3, 4 bedroom product. When you've got more 1 and 2 bedroom product, you get a lot more product. So a site that would have yielded 10 years ago, maybe 400 or 500 apartments, you're now maybe yielding 120, 130 apartments off that same site. So that's not necessarily a bad thing in that that's where the demand is and you're building for where the demand is. But if we're shooting for 1.2 million new homes over the next 5 years, you then need an awful lot more apartment projects to go ahead, targeting that 3 and 4 bedroom product than you would if you were targeting more of that 1 and 2 bedroom product. But this is a function of site costs have gone up so much, construction costs have gone up so much, wages have gone up so much over the last couple of years, that developers simply can't build that product at that price point anymore.
Yeah, it's interesting, isn't it? You would think construction costs may sort of be fairly flat or come down, but they never do in Australia. Obviously, a big part of that is the wages component, strongly unionised workforce across construction and development, but also, the quality of the apartment that needs to be delivered is very different from it was a few decades ago. A lot of the debate in the property and real estate circles is around zoning. I was down in Kings Beach in Caloundra last week, and there's a huge chunk of that suburb that's zoned for high density, pretty much anywhere near the beach, to be honest. You can get 7-story developments in, but there's lots of other parts of the country where you've got 3-story height limits, and you think there would be some easy wins around, particularly around train stations, where at the moment you've got in Brisbane, for example, LMR2 zoning, but it would be much, you think it would be an easy win to get some of those areas up to sort of a 10-story height limit. But I suppose a lot of the debate here is about structural versus cyclical. I can certainly see how over the long term, by relaxing zoning restrictions, you would get in aggregate more supply. But obviously there's a cyclical element to this as well. I took the kids down to Bluey's World in Brisbane at Hamilton North Shore down there. I mean, there's enough land there to maybe have 30,000 people living across the suburb, but it just isn't happening at the moment. I think the previous cycle we overbuilt supply for a period, but at the moment the demand for new housing just isn't there to get the pre-sales up. But yeah, I've seen you sort of you've been part of this debate on zoning. What do you think the zoning changes can and can't fix in the property market?
Yeah, Bluey's World story is an interesting one. I'm old enough and been around long enough to remember when North Shore Hamilton was first announced. And from memory, it was actually meant to be finished by 2025, completely built out. And they probably built out less than a quarter of that.
It's a wasteland. Yeah.
It's an absolute wasteland. Look, I think, there's definitely some quick wins to be had by allowing, relaxing some of these zoning restrictions and allowing more building. And you will get more housing if you make it allowable, at least initially. My concern is the sustainability of that. And a lot of people will point to what's happened in Auckland. And we did see a big upswing in building consents when they did relax zoning restrictions in Auckland. At the same time, it was flagged very early, and you had the interest rate cycle moving in your favor at that time, which helped. And I'm probably more interested to see over the longer term how that delivery of supply continues. I'm somewhat more skeptical that just relaxing zoning is going to lead to more housing ad infinitum. And as you say, it's a cycle. Back in the mid 2010s, we were building a lot of housing because we had a lot of foreign investment. Interest rates were sliding, construction costs were not rising, inflation was low. And now you look at where we're at, we've had a big surge in construction costs, inflation's been elevated, interest rates are the highest they've been in 12 years, and these projects just aren't feasible. And I think in the debate about relaxing zoning laws as well, there's just this assumption that development is easy. And I think that really underplays the hand of the property developer in this. I think development is actually quite difficult. You've got to have access to finance. You've got to have enough money to pay all of the consultants. You've got to have those relationships with the council to be able to negotiate through approvals. And then you've got to, find a builder. You've got to have that relationship with the builder. And I think there is clearly an assumption that the development process is a lot easier than it really is. And it's a lot less risky than it is. And I think that's why, changing zoning rules can certainly help. I don't debate that at all, but I think we need to do a lot more than just changing zoning rules to get that consistent higher level of supply happening.
It might make the cycle more a bit smoother, actually, probably less in the way of boom bust cycles. But yeah, as you said, as a part of a suite of factors, red tape is obviously quite a big issue. Government taxes pretty high actually on new builds in Australia. And I think as well, if you look at the US and increasingly in London, a lot of the new supply comes via institutional landlords and build to rent, and that's a very nascent but growing industry in Australia. So probably in future cycles that will have a bigger role to play. But maybe when interest rates are a bit lower than they are today.
Yeah, I think just quickly, the other point there is, as you said, like institutional is very prevalent in the US and the UK. It is growing here, but basically until you can't build something in Australia in most instances until you've got a level of pre-sales to go ahead and build it. And that is a key restriction on why we don't get more supply. And especially until that gap between existing home prices and new home prices narrows, that's going to continue to be a challenge.
I think funding markets will pick up, but I think super funds would love to invest in institutional housing, built to rent housing, but at the moment it's just not a big enough and liquid enough asset class to be able to do so. But in the future, it may well be. Are you seeing anything in the stats on Melbourne recently? I guess so many people ask me, is the market turning around? But frankly, I go to Melbourne once a year now for the grand final and no other time. So I'm not really close to what's going on. But are you seeing anything in the stats that suggests sentiment might be turning?
I definitely think sentiment's turning. And I mean, if you look at Melbourne now compared to most other capital cities, it's really affordable. Like Brisbane hasn't been more expensive than Melbourne since back in the early 2000s. It's now more expensive than Melbourne. That gap in pricing between Melbourne and Sydney is the widest it's been in quite some time. And even Perth and Adelaide prices are getting quite close to what it costs to buy property in Melbourne as well. The challenge in Melbourne is there's still quite a lot of stock on the market. Now, the last couple of months, we've started to see fewer new listings coming onto the market in Melbourne, but we've still got that elevated level of stock overall. But I think as that starts to moderate and as interest rates come down, more and more people are going to go, actually, this represents pretty good value. If you look even at apartments in Melbourne at the moment, the rental yields on an apartment in Melbourne are the highest they've been in about 25 years. But of course, there's additional land tax on investors in Melbourne, which in Victoria, which is scaring them off. But I think that, once that stock on the market starts to moderate a little bit and interest rates come down, I wouldn't be surprised to see Melbourne being one of the best performing markets in terms of price growth going forward, because there is some really good value properties in Melbourne. And yes, they're different cities. They're not, but in terms of the number of people living in them, Sydney and Melbourne have got a fairly similar population now. And some of the buys you can get in Melbourne very close to the city, you would probably be paying, 4 or 5 times as much if you're buying a similar property in Sydney. So I think there's early green shoots there in Melbourne, and the larger likely cut in interest rates is probably going to be quite positive for that market.
We've often seen over the past 20 years or so that the most affordable capital city has often been subsequently the best performer. It certainly happened in Hobart, and then Perth has had a run. Brisbane's relative affordability gave it a good run. And I suppose, Darwin might be classified more as like a regional market more so than a capital. But you would think, Melbourne potentially would be the next cab off the rank, just from a relative affordability point of view. And now you're more of a Brisbane boy, Cam, and Brisbane, the city has come such a long way since those childhood piano lessons at Coorparoo Mall. But we finally got some announcements over the past fortnight on Brisbane Olympics plans. So it seems it's funny for the sustainable Olympics with no new stadia. It seems we've got more stadiums being built than you can shake a stick at. But so it looks like new stadium for the old Ekka Showgrounds. I think that's a 20,000 seater. I can't believe they're building a 25,000 seater swimming pool stadium at the old Centenary Pool. I don't know how many people go to watch swimming, but apparently a lot for the Olympics. But also Victoria Park will be the centerpiece. Then there's the tennis center and so on with all the dozen courts around it. Obviously, that's a lot of infrastructure for Brisbane, but also it's sort of more of a Queensland Olympics when you look at the investment in roads and infrastructure and stadiums all around the state. Do you think there'll be any sort of flow-on impacts from that? I know there's been plenty of studies done on the impact of Olympics hosting on various cities over the years. What do you think for Brisbane?
Look, I think as a Brisbane person, my personal view was why not just replace the Gabba? But I think Queensland Cricket and the AFL got their way. They didn't want to lose a stadium for several years, and they got Vic Park. But you've just built all this new infrastructure to the Gabba. You've got the Cross River Rail stop right there. So yeah, look, I think some of the decisions are somewhat surprising. I think what's been missing around this Olympics and probably is still missing somewhat is infrastructure upgrades. The Cross River Rail was announced before we even got the Olympics. And we know that, new roads, new train stations, things like this are what really drives the improvement in the livability of a suburb and of an area. And we just haven't got much around that. Now we've still got 7 years until the Olympics. There's still the ability to make some announcements about that. But I don't see a lot of what's been announced in terms of these stadiums and things as really driving property prices higher. What I think we will see with the Olympics is more exposure for Southeast Queensland, and that might start to attract more investment into the state. But I don't look at this and go, this is going to be great for property demand in this area, particularly because new stadiums, great, but where's the new trains? Where's the new busways? Where's the new major roads? And there's been none of that around this announcement. And I guess that's probably a case that we're trying to do a more sustainable Olympics, certainly than what we did back in Sydney in 2000. But you wonder, in terms of the legacy of the Olympics, is it actually going to make Brisbane better and Southeast Queensland better? And I don't know. As you said, 25,000 person stadium at Centenary Pool. That has the sniff of a white elephant, if ever I've seen one.
Yeah, I mean, think back to the London Olympics, and actually the boroughs, they got the investment, like at Stratford and the new stadium in the East End where West Ham now play. There has been some sort of legacy there, and there was an uplift to housing markets and so on in some of the boroughs that got the biggest investment. I go to the Gabba every fortnight, and there's something had to be done because it's not up to modern standards. You're standing in piles of urine while the power cuts are happening and the floodlights are flickering on and off. Obviously, it's not up to 2025 standards, but I suppose on the plus side, that site can now be used for an entertainment centre, for housing. The school won't have to be raised at East Brisbane. I've got friends who go to that school. So, yeah, there's some plus sides. And as you said, the Gabba is getting a lot of investment anyway with the Cross River Rail and all of the gentrification around it. So, yeah, it'd be interesting. But I would say probably quite a lot of that price growth is actually baked in because we've seen such a good run for Brisbane housing anyway since 2020 or thereabouts. So what do you, final question, any sort of things we should be watching out for over the next few years? Any X factors or black swans that are on your radar?
I wouldn't say there's any black swans in particular, but look, as we kind of alluded to, I think the Melbourne market's certainly one to watch. I also think as the Sydney housing market gets more and more expensive, more and more people moving out of Sydney. Now, a lot of people over the last few decades have found their way to Southeast Queensland. Southeast Queensland's obviously nowhere near as affordable as it used to be. So I think it'll be interesting to see if people from Sydney and surrounds start moving to other parts of the country. In saying that, it's very expensive anywhere near a beach, anywhere in the country these days. And people leaving Sydney usually want to go and move somewhere where there is a beach and there is some water. In terms of black swans, look, there's nothing on my horizon, but I would kind of say, we have had a very strong run up in prices over the last several decades. And my question is, how long can that continue to go? If we think about what's driven it, more women joining the workforce, boosting household incomes, that's probably not going to go that much higher over the next little while. Interest rates at the start of the 90s were 18%. They fell to basically nothing during the GFC. they're a bit higher now, but we're not going to get as big of a boost from borrowing capacity from lower interest rates as we did. And I think about credit, it's got a lot harder over the last 10 years to access credit. A lot of the driver of price increases through the 90s and early 2000s was credit was so much more easy to access. So, and just where property prices are now, they're so elevated that I think people should be mindful that property probably won't be as much of a one-way bet going forward as it has been in the past. You're going to have to be much more selective with the properties that you do buy. And as we get a push for more density in cities as well, I mean, one of the things about a lot of apartment projects is the prices of them don't really rise. So if we want more density and more people want to live that way, they're also going to have to be accepting of the fact that they're probably not going to build much equity in those properties that they do purchase. So these are the things I kind of think about that we're looking at in the changes in the property market going forward. Whether any of those are really a black swan or not, I'm not so sure, but certainly those are things that tick over in my mind.
That makes sense. I think you're right, particularly since the introduction of APG 223, borrowing capacities are much more constrained than they would have been pre-2014 and especially pre-2007. So if you're going to be buying property, you need to make sure that every dollar of that borrowing capacity is going towards an asset that's going to work for you or deliver some results, because you can't take the same scattergun approach and assume that everything will pile forward as it used to. So yeah, some pretty good advice and good points there. Cameron, you mentioned you've got a Substack that people can go to, and I think CM Kusher on X, formerly Twitter. Is there anywhere else people should track you down?
That's the main place. So CameronKusher.substack.com. I'm on LinkedIn. Follow me there. As you said, Pete, I'm CM Kusher on X or Twitter. They're the main places. But yeah, while I'm between jobs, I'm posting regularly, sharing my thoughts, writing my opinions on things. Tell me I'm wrong. Tell me I'm right. Let's have a debate. Let's have a chat. And yeah, I'm still around and still busy with myself.
And as we said at the outset, if you're looking to hire a top analyst in the property market, Cameron's your man. You don't strike me as a person who would sit around idle for too long, Cam. So I'm sure you'll be back in the market and working productively very soon. So yeah, thank you so much for coming on the show. You're always our most popular guest for your insights, which are always so highly valued. So thanks very much, and hopefully we can do one again soon.
Yeah, thanks for having me, Pete.
Cheers.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.